Picture this scene. You're a business owner, you're having a meeting with your accountant. It doesn't sound very exciting already, does it? But bear with me. And before you switch off and go, oh, this is boring, this is for you if you are one of these two people. If you're sitting there with your accountant and you're nodding along and agreeing with them and signing and getting out of there relatively quickly, but in your head, you're like, I have no idea what this is about. I don't understand that. I don't get any of this, but they seem like nice people and I trust them and I'll just sign and get out of here. This is dull. That's person A. Person B is, I'm looking forward to seeing my accountant. We always have great conversations. The information I already understand, but now I can have questions with them. I can challenge what I'm doing, get them to help me plan my next strategy as to what I'm going to do next with my business. Those are kind of the two people, or anything in between. That's what this video is about, is to help you understand, whether you're either of those people, how important it is for you to understand this data, and more importantly, show you. I'm going to show you how to read a set of accounts, what to read, what to understand, what you're going to see, so that you can go to your accountant and have a decent conversation. And if you're already doing that, have an even better conversation and use this information to make more money and have an easier life. That's the mission. So I've broken the board into two pieces, over here and over here. Here is the scenario with the accountant. The accountant is having a meeting with you. They're presenting to you, for the purpose of this and the people that I work with all the time, one of three sets of accounts. There are others, but I'm just going to stick to the basics here for business owners. You could be a sole trader. You run your business yourself. You don't have a structure, a limited company or anything. You just do it yourself. You're classified as a sole trader. You could be a partnership. You could be in business with your spouse or somebody else or multiple people, but you share the responsibility of the business. And then the third one is limited company. You've got a limited company, you run your business through a limited company, and the accounting process arrives at these results. The accountant basically can produce all of these. It's just a report, depending on the structure. I'm not going to go into the structure today, but depending on the structure, they'll deliver these reports. The difference, of course, is the sole trader accounts are normally very simple. Sometimes just one page. Sales, expenses, profit, hopefully, not a loss. Sales, expenses, profit. That's probably the most easiest one to read because it's kind of obvious, but there'll be things in there that perhaps you don't. Partnerships, funny enough, partnerships are very much the same as sole trade. Sometimes there can be a bit more to them because they've got, perhaps the business is bigger, so there's a balance sheet, perhaps there's partnership splits in there, the way the partnerships is structured. So it's a little bit more complex. Sole traders can be a bit more complex as well, but partnerships tend to be just a little bit more complex. And then limited company. You ever seen a set of limited company accounts, like 12, 14 pages, and you read it, what is all this stuff? It's all these pages. Actually, it's reporting exactly the same information as a sole trader. But we have to have this information because of something called company law. Company law says you have to put these because it might apply to you as one-man band or husband and wife running your business and you've got a limited company, but it also applies to the great big companies that are running millions of pounds for their business. So the structure of the reports is what the accountant's job is to produce that. But who's he actually reporting to? Well, just check I've got room on my board over here. He's actually talking to HMRC, and if you're a limited company, Companies House. He might also be talking to the bank because you might want some figures for the bank. But nevertheless, that's kind of why these reports exist, to be sent out to the authorities, if you like. But the style and the way those accounts are produced aren't necessarily the thing that you should be focusing on. The data in it comes from your bookkeeping system. And it comes right back from the beginning when you raise a sales invoice or you buy something and so you receive a purchase invoice, or you pay money in and out of your bank. That's, in its simplicity, that's what goes on in your business. You buy things, you get an invoice for you buy things and you get an invoice, you sell things and you give an invoice, and you pay money in and out. Now, you may have some complexity to that. You might have multiple bank accounts, you might have different sales processes, you might have staff, you might have materials, you might have machinery and assets and all the rest of it. Let's bring it to the basics. You sell stuff, you buy stuff, and money goes in and out of your account. Let's keep it really simple, because that's all it is. That's all it is on a practical day-to-day basis. You go about your business, you buy stuff, you sell stuff. That information needs to be fed into your accounting system, into a database, a piece of software in the cloud that collects all of this information. Over the years in the UK, we have now got cloud-based systems. We've got Making Tax Digital. We've got all these things happening. So if you're not in the cloud, it's probably the place you should be. Get a cloud-based system, work out how that data goes in. Now, that not necessarily is your accountant's job, unless your accountant offers that service to do bookkeeping as well. Many do. They might also offer that service to teach you to do that. Many do. But the point is, you need to understand this process. Now, here's the thing. You're sitting here. Let's put you back up in the middle here. You're sitting up in the middle here, and you've got access to all of this information, and you're going to have this conversation with the accountant. You can delegate this job. You can delegate it to a bookkeeper, your accountant, to somebody else. You can delegate the statutory accounting to your accountant. You can say, you do that, you do that. Delegation, I'm all for. But what you can't do as a business owner is you can't delegate the responsibility. The professional accountant, the bookkeepers will do their level best to make sure that you're looked after. They will do their level best. And if you found good people in your life, great. They will do their level best. And they will take on a huge amount of that responsibility. Make sure the VAT return is done. Make sure the tax is paid. Make sure the calculations are done correctly. They will do that. But above it sits you. You have to have this responsibility that you understand it. And this has been prompted by my lovely wife Vicky, who has just completed, as I record this video, she's just doing the last edits to her book, Big Tom. Big Tom stands for Business is Getting on Top of Me. And in that book, she talks about a real life scenario where she, in a previous life, was having conversations with the accountant, nodding along, feeling very stupid that she didn't understand, and ashamed that she couldn't ask the accountant. She couldn't ask the accountant questions because it made her feel dumb. And she's not dumb, she just didn't know. She didn't understand. She hadn't learnt that part of business. And so what she found herself doing was delegating the responsibility for both the bookkeeping and that, and just go, that's not my role. Now, who did she delegate it to? Well, her business partner, her then husband. And so you can't even delegate it to your team. Whoever you're in business with, whoever's your team members, if it's your spouse, you can't just delegate. You just go, well, my wife will do the books. She's good with numbers. She's good with spreadsheets. Great, she does it, right? I don't even think about that. I trust her. Great, you do. Brilliant. But you have to understand, which means sometimes you're going to have some difficult conversations, which means sometimes you've got to learn. Let's take you on this learning journey. Okay, step one, we got to put the data in the box. That's a bookkeeping exercise. We can cover that another time. Step two is we've got to validate it. Is what we've put in actually correct? Just mathematically correct? Has a human made a mistake? Did we put the invoice in twice? Did we put the money in twice? Did we just make a mistake? Did we type a 38 instead of an 83? Easily done. Human beings do that. Now with AI and technology, we can eliminate a lot of that, but there still will be mistakes. The biggest mistakes that we see a lot of, and sometimes they're the hardest to spot, is what about the information you don't put in? We can check what you put in, but we can't check what you didn't put in. But there are processes within the checking system to look at that. The ultimate check is you. Why? Why can you be the ultimate check? Well, if you've been busy for the last 3 months, and I mean busy, you've been chasing your tail with customers, you've been out invoicing, you've worked your way through the last 3 months, and you're sitting here now and going, it's been a busy couple of months, but I think we've done quite well. We've had lots of work. Well, when you read the report about sales, one, you will be very familiar with all the customer names because you dealt with them. And two, it'll be kind of obvious if you read it if something's missing. Our brains are capable of just reading through and go, where's that job I did? Because you'll remember the job for whatever reason. It either didn't go very well, or it went very well, or you had a pleasant experience or a bad experience. There'll be a memory to do with the job that will, and you go, where's that job on the list? It's not on there. So it is possible that things get missed. Now, if that is the case, the checking process, whether you miss things or you make mistakes, what we do is we use that checking process to improve the next time we put stuff in. Because quite often when we put data into the box, you might find, oh, I've got 10 mistakes this month. And you've probably got one mistake 10 times. Or 2 mistakes 5 times each, or a couple of mistakes, right? Often it's habitual. The mistakes that happen here is because the data went in incorrectly in the first place. It was missed because there's a process here to get the data in. Years ago, I was working for somebody, and this was long before emails. They would open the post in the morning at the big table in the office. They'd come in, they'd pick the post up, literally from the letterbox as they came into the office, took their coat off, sat at this desk and slit the post open, opened up all the post and put it into piles. Okay, that's letters, that's got to be dealt with. Oh, there's invoices. And this particular chap had a habit of wandering around the office to distribute this stuff. And every now and again he'd get interrupted and he'd just put it on the table and off he'd go. And you'd wander along later on in the day going, what's that pile of paper there? And you knew what it was. It was like a pile of invoices that haven't gone to the right place. Literally, could have gone in the bin. So the process of getting this stuff in is really important to get the checking right. Now, the reason I'm labouring on that point, because if the data is right, if you can say to yourself, do you know what? Yeah, I can tick the things that I need to checking and it's right, then we can move on. It may be that you've got to put some adjustments into your books. Maybe you've got to put in some work in progress, some stock, some depreciation, some accruals, prepayments. Those are language that you need to learn to understand what they are. What do they really mean? Well, these are things that don't come from sales, purchase, money in and money out. They are entries that make a difference to the reports. So if, for example, you've done a whole bunch of work this month and you haven't yet invoiced your customer because timing, your books will have a big amount of cost, but no sales. So if we were to run a profit and loss from here for that month, it would show a loss because you've got costs and no sales. And you go, well, that's not strictly true because I haven't put the sale in yet. So the way you do that is you take those costs and you move them forward to the next month when you do have the sale. So you reduce the costs. And you take those costs and you move it on. Now, what we're trying to do within those adjustments is we're trying to say, I've got some sales this month. Have I got all the costs that relate to that sale? Oh, the sale was delayed. Okay, move the costs so it relates to the sale. Okay, sometimes we can go backwards as well. Okay, we can go backwards and forwards. And it normally moves things into each of the periods that you're working to. Could be a month, could be a quarter, could be a year. Ultimately, the cumulative doesn't really change. Because once that sale has happened, if it happened next month and the purchase happened to the previous month, if you ran the accounts for the whole period, it wouldn't matter. It's only what we call cut-off when you get to the period end and you run a report that you might need to do adjustments. Now, every business is different. Most adjustments may consist of no more than a handful. There's depreciation, accruals, prepayments, allocation of profit, a bit of interest. Maybe you've got to put a payroll journal in, right? That's kind of it for most businesses. What you got to do is understand them, understand the impact on them. Once you've understood that and you know the data is right and you understand your journals, Well, now we can get to the next stage, stage 4, which is we can run a report. You can actually go to the system, press the button that says reports, and run some reports. And I'm going to actually share with you 3 reports that I recommend that you always run. I recommend these reports because if you can understand these 3 reports, any other report that you run off the system will mean a whole lot more to you. And the reason for that is these 3 reports are the last part where you can confirm that it all makes sense. And if these 3 reports make sense to you, 1, you can go back into your system and look at other reports because they'll make sense. And 2, this will then change the conversation with your accountant, because the accountant's report is basically a duplicate of what you're running here, but you're going to run it in a much easier to understand format. The first report we're going to run, let's put them here. Report number 1 is called a trial balance. It's on every computer system. And what the trial balance represents, in its simplicity, is everything that you put in here, plus your adjustments, will be on this report. 100%. Everything. There'll be things on the left and there'll be things on the right. And there'll be some descriptions against everything going down here. And at the bottom, there'll be 2 totals. In the old days, our mission was to make sure that all the debits and all the credits came to the same total. That total in and of itself doesn't mean anything. It just says that all the debits and all the credits agree mathematically. Now, if you're using a computer system, I can't remember the last time I looked at that. It just works, right? It just works. It always, a bit like your bank statements, they always add up. So this will always work. Therefore, if that report is a summary of everything in your bookkeeping system, it's also the report that the accountant uses to produce these reports over here. Now, your accountant might come back and make some more adjustments, or he might come back, she might come back and put more data in. And if that's the case, that's because your bookkeeping, on a scale of 1 to 10, 10 being perfect and 1 not being so perfect, if your accountant is coming back in, then your books are not perfect. If you're only scoring a 4 out of 10 for your bookkeeping, your accountant has got a lot more work to get these right. If they're 10 out of 10, the flow of data from here to here to here becomes so much easier and faster, which means you can have live conversations. I am currently working on 4 jobs at the moment, well, not my team is, 4 jobs at the moment, whereby the month end, which was only 7 days ago, they are producing accounts to that month end right now. 4 jobs done. Probably, today is Thursday, probably by next Wednesday, they'll all be done. So 10 days in, 12 days in, 2 weeks in, we've got all of those accounts, and we're doing lots of accounts, so we've got lots of things to do. If I was just doing the one set of accounts, I would have them up to date. My own books were up to date for the previous month on the 2nd of the month. I sat down in the morning and I brought them all up to date. So it's possible to have live data. Now that means that when you have a conversation about the data, you're having a conversation about something that happened last week, last month. It's live, and therefore it becomes relevant to where you are today. What you're trying to do today, what you're trying to do tomorrow becomes relevant. And part of the problem of having an appointment with your accountant, and the accountants struggle with this because, and I've coached lots of accountants over the years, they struggle with it because they've got lots of accounts to do for lots of business owners. And most business owners fall into this camp where they don't really understand. And therefore they put off even giving the accountant stuff in the first place. And they put off booking the appointments. So there's a time delay. So you're now sitting down in November. It's just before Christmas. Maybe even December. Woohoo! and you're talking about your accounts to the 31st of December of the previous year. And he's telling you all the things that went on last year in those accounts. I don't know about you, but I'm sitting there. If I was sitting there, I'd be going like, I don't even remember what happened last month, let alone last year. And I know that happened last year because I was there. And I've done loads of stuff since that means that's kind of almost irrelevant. And therefore, why are we having this conversation? Because it's really boring. It doesn't fit with what I'm trying to do next. And of course, if you then try and have a conversation about what you're doing next year, you've got this year, which he doesn't know about because he hasn't spent any time looking at that data. And so you've now got this gap between your accountant who's seen all the last year's stuff, you're focusing on the future, and this gap in the middle is this void of information that nobody really understands. And so you're a bit hesitant about moving forward. He has no way to advise you. And the whole thing is causing issues. Now, this is the moral of this. If you don't understand this and you don't have these conversations and you run out of money, whose fault is it? Ultimately, it's yours for not understanding it. It's okay to run out of money. It's okay for a business to fail if you understood why, if there were some circumstances and you did everything in your power, because you would make a decision to close that business on your front foot because that's the right thing to do. But we don't want you to do that. We want you to succeed. So therefore, if your business is struggling, we've got to figure out what you need to know to stop it from struggling. And therefore, it comes to the next two reports. If you look carefully at this trial balance, and your mission is to read it and understand it, and every line of data that's coming down here, and there could be many, it could be 2 pages, it could be 3 pages, a limited company, it could be 3 or 4 pages, great. All I would suggest you do is print it out on a piece of paper and just say to yourself, do I understand each of these rows coming down here? Well, because some of it you'll understand. Let's take the obvious, sales. There'll be a category called sales. And over on the right-hand side in the credits, there'll be a number. And I'm just going to put the word date there because date is critical. Assuming that we're going to run this for a year, so you've set the date for a year, you're going to look at that. That should be your sales for the year. It'll be a total. You might already think, that's great. I know that total because it might fit with your targets and your marketing. But if you click on that number on your computer system, it will open up another report that will give you a breakdown of all the transactions that make up that number, which will be the sales over here. So every sale that you fed in will come out as a total over here. That's an easy one, right? If you do that with purchases, if you do that with wages, if you do that with other costs, other income, it'll all make sense because you'll go, oh, I understand that. So you go, yeah, I understand sales, and you better tick that. But there will be things on there that you won't understand. Okay? We'll come to that in a minute. But if we draw a line, and it won't necessarily be in half, but there'll be a line. And depending on what your software is set up as, the first thing above, just underneath that line will probably be sales. If you draw a line immediately above sales, everything below sales will belong in your profit and loss report. Okay, your profit and loss report. And everything above will belong in your balance sheet. And therefore, your profit and loss and balance sheet is your trial balance, just laid out in a different way. Your statutory accounts for your limited company with multiple pages about all the company law and dividends and da-da-da-da-da, all that stuff that goes on in there. Behind it is your trial balance, which is why if your accountant can't finish the job from the trial balance you give them, they have to come back and make some more adjustments and put some more data in to correct the books to bring them up to a standard. Sometimes your accountant is under such a tight budget because you've screwed him down on price, her down on price. I say him, her, it doesn't matter. They do the adjustments in their own working papers and they don't put them back here. And they don't put them back there because you don't care. You're not interested. You're not showing any interest. Therefore, when you run some reports next, and this is what I've seen over the years, 3 years in, 5 years in, you suddenly pay attention to this and it doesn't make sense because there's a bunch of things that your accountant has put into these figures that they haven't put into these figures. And I see this a lot. Personally, I think the accounting profession is wrong. I think the accounting profession should always put their entries back in here to make sure that this trial balance is right. Many of them do. I'm not criticising the accountant, but I've seen plenty who don't, who say that's not my job. Their job is to get the accounts out. You're paying me to get these accounts out. They take your trial balance, do a bunch of entries in their working papers and stick them out over there. So therefore it becomes meaningless because you've let go of the responsibility. So what does a profit loss and balance sheet? Oh, quick thing. I put the line in the middle, assuming that sales would be here. I think a lot of systems use like code 4000. If these entries below that are mixed, if you can't draw a line and go, oh, that's my P&L, that's my balance sheet, and it will become obvious. It's because the structure of this trial balance is incorrect. These codes, these descriptions need to be put in a different order. So you can reorder it back in the settings over here. And many people don't bother. They just add the next code on the bottom to the next available line. What you should do is put them up within the numeric system. So you might find that your system goes 4,000, 4,100, 4,200, 4,300. And you've got a new sales item, so you put it as 10,000. No, put it as 4,050 between 4 and 100, because then it will sit up here in that line. But nevertheless, even if you don't, it'll still pull out a profit and loss and a balance sheet separate and do this properly. So that's just part of the settings. Now, when you've got a profit and loss, the profit and loss is the easy one to do because it doesn't matter whether you're a sole trade partnership or limited company, you're going to have profit and loss. You are going to see sales, you might have cost of sales, and you might have overheads. And then at the bottom, you hopefully have got a profit. Now, the profit and loss is the easiest one because sales less cost of sales, if you've got cost of sales, will equal gross profit, less overheads will equal net profit. Now you will find when you read these accounts, there may be different language used, particularly if you use maybe an American system, they might use accounts receivable, accounts payable, whereas another system might use debtors or creditors. But essentially, you've got to understand this, that sales less costs equals profit. The fundamentals of business is that you sell some stuff, you've got some costs, and the bit left over is for you. That bit left over for you is profit. Now, what often happens is you look at that figure and go, well, that's a bit depressing. I made £1,000 for the entire year. What the hell's going on? That feels really depressing. I know I've made more money. I've taken some myself. Because inside this report is going to be a number of figures that you will understand. Because they probably represent you. And they represent you in the form of a salary, if you've got a PAYE salary, a dividend. They represent you if you've paid a pile of money into a pension fund. But they also represent you because as you look through the costs, maybe your business runs your motor car for you. Maybe your business pays for some of the other things that go on in life. Maybe you go out to dinner a few times and all of those costs are in there. You've put them down as marketing expenses. You put the business car down as travel expenses, motor expenses. Great. And probably what you've done is put all of it in. Why not? Because if I reduce my profit, I'll save my tax. Great. But by definition, you're reducing your profit. So you've now got that conflict between, I thought I made more money. Well, what you want to do really is take those out and put them afterwards and calculate a profit before you and a profit after you. Unfortunately, many of these tools, including the entire language of the accounting industry, never presents these reports in this way. So the only way to present that report, if you wanted to incorporate it, is to take this data, pop it into a spreadsheet and create your own report. And the great thing is with all the AI tools around now, it's actually quite easy to do that. So Google Sheets, Canvas, for example, you could use just to create your own report. And the point of it is, whether the figures are included in there or not included there, do you understand that report? Can you pick that report off your system, run the P&L, run the trial balance, look at all the P&L items and go, I understand that. I understand that profit, what it really means, where I'm at. Because that report alone is the basis of what you're going to do next. Because think about it. If you ran that report for a year, basically it's telling you that for the last year, you did a bunch of things. You got up in the morning, went to work, did a bunch of things, and that's the results. Happy with the result? No, you want it better. Well, all of the things that you did, all of the habits, all of the processes, all of the work, all of the sales and marketing, all of the tactics that you put into your business to make that result was down to you. And if you want a better result, you've got to change this bit. You've got to change what goes into the system. This is where the work happens. Right back over here, you've got to change this. Now, that could be that you've got to put your prices up. That could be you've got to get better at sales and marketing. That could be that you've got to change your business structure, employ new people, fire people. You've got to make some big decisions to affect these results. Because if you keep doing the same thing, you're going to get the same result. Therefore, this information gives you a clue, gives us all a clue as to what that means going forward. When I did my figures to the end of last month, I looked at the results and went, yeah, I'm not really happy with that. It's good, but it's not what I want it to be. It's paying the bills, we're living, got a nice lifestyle, but there's some things, some goals I want to achieve. There's some toys I want to buy. There's some experiences I want to go on, holidays to pay for, family to look after. There's things I want to do in the future. And if I keep doing that, it's got to wait a long time before I save up. Or I could go and get more sales. Or I could do profitable sales. I could increase the prices. And if next year I can get a better result, or next month I can get a better result, or next quarter I can get a better result, I'll have more cash for me to do the things I want to do. It's the whole point of doing this, right? To be happy, to do the things you want to do. So that is a fundamental, important report. Now, to finish up, the balance sheet. The balance sheet it's a tricky one because people don't get the balance sheet a lot because quite often it's wrong. And it's wrong for two reasons. One, because the data isn't right in the first place. So you could be running this report right now, and because you haven't done the checks and you haven't done the adjustments, it's wrong. So we got to get good at our bookkeeping. We've got to learn this bit. And so because it's fundamentally wrong up here, any balance sheet you run is also wrong. Now, the clue is, if you run your P&L and you spot a mistake and it's wrong, inevitably the balance sheet will probably be wrong as well. For every debit, there is a credit. And if there's a debit or a credit on your P&L, the other side of it is probably on your balance sheet. Probably. So the balance sheet can sometimes be wrong. But let me just help you understand what the balance sheet is. The profit and loss runs for a period of day one to day whatever. So it could be for a month, it could be for a quarter, it could be for a year. So it's a period of time. The balance sheet is only ever at one day. So you could run that at the 30th of June, 26. It could be, it's nearly always month end. Okay, whatever the month is, you run it. And it's normally the month end to the date you ran here. So if we ran the accounts from 1st of July 25 to the 30th of June 26, we would run a balance sheet for the 30th of June 26. The balance sheet is always the last day of your P&L. And on your balance sheet, you've basically got assets and liabilities. That's it. And it's a list of your assets and your liabilities on one day. The day after, they could be different. The day before, they could be different. Why? Because it's affected by your P&L. If your bank balance has £10,000 on the 30th of June, and on the 1st of July, you make a sale of £5,000, your bank balance on the 1st of July will be 15,000. So it'll change. But because your bank balance has changed, so is your sales for the 1st of July. So kind of like the P&L is the daily things that happen, and every time you pay money in and out of your bank or raise a sales invoice or collect a purchase invoice, the other side of it is going to be an asset or liability, and somewhere along the line, it's going to change. So that's why it's done on one day. So it's only ever done on one day. So you might be looking at your accounts going, well, 31st of December last year, here's my assets and liabilities. Well, that doesn't look like what it does today. Well, of course it doesn't, right? Because that's what it did on the 31st of December. It's one single day. Now, what's in assets and liabilities? Well, they're split between fixed assets, sometimes intangible assets as well. So a fixed asset would be a car or a digger or a tractor or a piece of machinery. It's a thing that you can touch, you can physically touch. And the reason it's an asset is because you'll use it again and again over many years. If you bought something that lasted only a short while, it would go in the P&L. So it's got to be long term. It's got to be something that's got a life to it, something that you can physically touch. So if you buy a computer, that'll last you many years. You buy a computer, you spend £1,000 on a computer, you put it in assets, and it stays there. Every time you run a set of accounts, you've still got that asset. Now, there's a thing called depreciation to write that off. Won't bore you too much with that. It's all to do with adjustments. But essentially, the asset is the solid things. An intangible asset might be, say, for example, a website. You can't touch it. Or it could be some goodwill. You bought some goodwill. You bought the goodwill of the business. You can't physically touch it, but it's still an asset. You've then got current assets, which is money in the bank, a savings account, a bank account, positive bank account, money you're owed. You've done the work, you raised the invoice, you haven't been paid yet. That would be debtors or accounts receivable, as the Americans use. So those would be current assets. Liabilities are split between short-term and long-term. Short-term are you've got an overdraft, or you've got a credit card, or you owe a supplier. It's all going to be paid in the next month or so. Or long-term is, actually, up in my assets, I've got a factory, and in my liabilities, I've got the mortgage on that factory. The mortgage is going to stay for a long time. The factory is going to stay for a long time, that sort of thing. But essentially, it's assets and liabilities. And the difference is often shown up as your net worth. So I said there was two ways that this balance sheet is wrong. And this might help understand the confusion that sometimes happens. The second thing is that when we run our assets and liabilities, they only show the monetary element of the asset and liability. So let's say you bought a building, and let's say it cost £300,000, and you bought that 10 years ago. That will sit on your balance sheet at cost, £300,000. Because that's what you paid for it. It came out of these numbers here. It came out of money. But that building may have gone up in value. It might be now worth 500,000. And that difference, that potential profit, because it is unrealized, in other words, you haven't sold the building yet, it doesn't really exist. It's hope value. I hope that I can sell it for more. I haven't tried selling it. I'm told by the professionals it's got a value of. I believe it's got a value of, but we don't put that profit into the books. Otherwise, you have to pay tax on it. And you only pay tax on it when you actually sell something. There's also sometimes when you're looking at your assets and liabilities, you have instigated other costs that go into your business. You might have been using your personal bank account to cover some of the costs. You might have established a whole bunch of things before your business started and given it to the business because it's just the continuity of your business. And that money that comes in and out of you has to be recognized somewhere. It either gets recognized in the books as an adjustment, or you just have to recognize it in your interpretation of this. That goes with up here as well. And I feel like as I've gone through this, I've done my level best to keep this as simple as possible, because it is a very complicated, complex industry, this whole accounting industry. But the message I want to leave you with is this. I don't believe you can pass on the responsibility. You can pass on the work of keeping the books. You can pass on the work of doing this statutory accounts. If your bookkeeping is not scoring at least 9 out of 10, but 10 out of 10, address that. Fix that. Whoever's doing the books needs to be trained. Whoever's doing the books needs to understand the system and process properly to get that working slick. fast. One of the challenges you could set is to say to yourself, by the 5th of every month, I want to see a trial balance, profit and loss and balance sheet from my bookkeeping system so that I can start reading it. And whoever's doing the books is going to go, oh, I can't do it. Yes, you can. You might take you several months to get there. Change the process, change the way it's done so that the data is fed in, all the automation tools, all the techniques that these software tools provide you to get that data in that box and checked as fast as humanly possible. That will then improve the standards that you operate at. This standard needs to be a 10 out of 10. Not for the accountant, not for the Inland Revenue, for you. Because the ultimate one of this is that here is a profit and loss and balance sheet. Great. We now know it agrees. We now understand it. Brilliant. You've arrived at step 4. You're running reports that are accurate. The ultimate is step 5. Step 5 is the most important step that you should be at. What does this mean to me and my business? What does that result mean? What can I do with it? How can I grow my business from it? What is it telling me? They're bigger questions. That's the question you should be having with your accountant. That's the question you should be having with your spouse, your consultant, your people who help you. What does this stuff mean? How can I make my business better? You'll know if your business isn't good enough because it'll be painful. You'll run out of money. You'll be worried. You'll be stressed. You'll be overwhelmed. You want to burn the thing to the ground some days because you hate it. That's not a way to live your life, running your own business. Let's make some money, enjoy life, and have an easier time with all this. Starts with understanding your numbers. If you understand your numbers and you're asking good questions, imagine now when you have a conversation with your accountant. Imagine them saying, oh, here's a set of accounts for your figures to the end of March. And you're saying, yeah, no, we're in June, we're another quarter on, you've got the figures out for me, great, and I can see the tax bill. I've had a quick look through, I can see where you've got my figures from, brilliant. Now, going forward, I'm planning to do this. Is there any tax things that I should be aware of? Is there anything that I should be aware of that we could do right now that will prevent a tax bill? That will save me some money going forward? Is there a better way I can structure this? I'm currently running as a partnership. Should I be a limited company? I'm a limited company. Should I be a partnership? I'm thinking about this, this, and this. Should I do this? I'm thinking about this. Should I put it into another company? Should I keep it in the same company? Should I change the status? What should accountant will go, bloody good question. That's a much better question. And do you know what? From the accountant's point of view, more bloody interesting. Producing statutory accounts from poor record keeping is pretty dull. It really is, because you're just spending all your time being a bookkeeper instead of being what you're trained to do. Most accountants spend most of their time being bookkeepers. And I'll be honest with you, most of them aren't very good bookkeepers. Good bookkeepers deal with live data, process it really fast and score 10 out of 10 5 days after the month end. Okay? So this information that comes out of here, just to recap, you want really good bookkeeping. You want to understand your trial balance, every line. If you don't understand anything, ask. Ask your bookkeeper, ask your accountant, learn, understand, because it's only your data. You're not having to understand a set of accounts for some big corporate company or some other business. It's your business. You should understand your business and your numbers. And if you understand the trial balance, I promise you, you will easily understand your profit and loss and your balance sheet because it's the same blooming report. Then if you go to your system and you go, oh, I can run this report off and this report off and this report off, it's using the same data as your trial balance. The only thing to be careful of is dates. Dates is the thing that catches all of us out, just to make sure if you look at it and go, that looks wrong, check the dates. Sometimes we run the things to the wrong date. I hope that makes sense. It's complex, and when I thought about this today, I thought, I'm going to go deep here today explaining this. If you've got any questions, leave them in the comments. I can always do another video, or I can pick just one area of this and go deep on it. Maybe you want to know more about these reports. I can go deep on that and not the whole concept. But I hope that you can now consider yourself somebody who can now have a meeting with your accountant and be a little light-hearted about it, a little happier because you feel more confident about it, and maybe you'll have a better conversation. And maybe, do you know what? Maybe you'll find that your accountant's service is more valuable to you if you can have better conversations. I'm out of here. Leave your comments. See you soon.